If you've gone back to the bank for your next property and they've come back saying, sorry, no more loans, I'm going to show you a way to unlock more borrowing capacity, even if you're already at your ceiling. I've seen this time and time again. You've got a solid income, 150K, maybe 200K a year. You've done the right thing, bought 1 or 2 investment properties. And now when you go back to the bank for the third, the bank looks at you like you've asked them for a spaceship. Sound familiar? I'm Naveen Merani. I've been on both sides of the desk in private banking, commercial lending, working with ultra high net worth clients with family offices. And I can tell you, there are actually several different levers we can pull to keep you moving. If you structure it right, from the start, you can keep buying property for a lot longer than you think. So let me show you how. But first, let me give you a quick rundown on why you hit a wall in the first place. The major banks are what's called deposit-taking institutions. They're regulated, which means for every dollar they hold from the public, they can lend out about 60 cents. And because of that, they're under responsible lending rules. They have to build a fat safety margin into their assessment. This is called a buffer rate. Right now, if the rates are 6%, they don't just see that you can afford repayments at 6%, they test you as if the rates were 9%. That's a 3% buffer. Sounds sensible from a risk management point of view, but it crushes your borrowing capacity. So that's lever number 1 we can pull. Understanding that not all lenders are regulated in the same way. And you can tap into non-conforming lender network. Non-conforming lenders don't use public deposits to fund loans. They are backed by private investors. That means that they can set their own rules and generally have a higher risk tolerance. So that might mean that they only use a 1 to 2% buffer, not 3%. So let's say you're borrowing $500,000 over a 30-year loan term at a 6% interest rate and earning $100,000 a year. With a 3% buffer, the bank will check if you can afford repayments at 9%, which works out to be $4,023 a month. If your monthly surplus after expenses is $3,600, you fail the test. But if a non-conforming lender only uses a 1% buffer, they test you at 7% instead. And those repayments drop to about $3,327 a month. Suddenly, you pass. That difference in the test rate can mean you qualify for more money. Using the same income and the same expenses, you might only get approved for a $500,000 loan at a 3% buffer, but with a 1% buffer, you could be looking at $575,000 to $600,000 in lending. I had a client in Melbourne renting where they lived, but owning 1 investment property. The bank said that they could borrow a maximum of $1.25 million. We moved their debt to a non-conforming lender and used the lower buffer rate and a better negative gearing treatment. Instantly, their borrowing capacity jumped to $2 million. Now, you do have to think of a non-conforming lender as a parking station. You don't leave your car parked there forever. You park it, get on with your trip, and when the timing is right, you bring it back home. In finance term, home means going back to a major bank once your income is improved or your property value has grown. The strategy is never to keep you at a non-conforming lender at a high interest rate forever. It's a foot in the door. Once you've got 12 months of perfect repayment history, we can check back in. Has your income improved? Has the property appreciated? Can you get back to a major bank at better rates? So that's the first lever you can pull to unlock more borrowing capacity. The second lever you can pull is to buy a property using a trust structure. A trust is a separate legal entity in its own right that can own assets, earn income, and take on debt in its own name. Your company acts as a trustee, controlling the trust and managing the property on behalf of the beneficiaries, which could include you, your partner, your kids, other family members. Because a trust is separate from you, some banks look at the loans entirely differently. If a property in the trust earns enough rent to cover all its costs, like loan, the rates, insurance, your accountant can confirm this in writing. Some banks will then ignore that loan when you're looking at your personal borrowing, which can help you borrow more. That's where the power comes in. For example, I had a client renting but wanted to build a portfolio. We set up trust number 1 for their first purchase with a 20% deposit. The rent from the property covered the loan and expenses, and the trust was self-sufficient. 6 months later, we created trust number 2 for the next property. Their accountant confirmed that Trust 1 was managing its own debts and the bank did not count that loan when assessing Trust 2. The same process can be repeated without the debt of the previous trust dragging down capacity. But the trust is not a magic bullet. You have to understand the give and take. The cons: you lose negative gearing benefits in your personal tax returns. The trust costs money to set up, often $1,500 to $3,000, and to run each year, maybe $1,000 to $2,000 in accounting fees. The property has to be cash flow neutral or positive for the bank to disregard the debt. From my time as a lender, I can tell you exactly how banks view this. If the property is under a trust, but it's losing money, they'll include the debt in your serviceability because they assume that you're topping it up from your personal income. But if the accountant can sign off that the trust is self-sufficient, then depending on the lender, they'll exclude the debt from the numbers. The pros: you can protect your personal borrowing capacity. You can keep adding properties without every past loan dragging you down. There's potential of a capital gains tax benefit later because past losses inside the trust can offset the gain. Now, sometimes the block in unlocking your borrowing capacity isn't the structure, it's how your income or your liabilities are treated. There are a few other levers you can pull to unlock more borrowing capacity, starting off with cleaning up your liabilities. Even unused credit cards hurt you. A $10,000 limit can cut your borrowing capacity by $25,000 to $30,000 because banks allocate a $380 a month repayment against that card. Whether you use it or not, cancel the cards you don't need. Another lever you can pull is finding the right lenders that will accept your income type. For example, I've worked with clients who get $50,000 worth of vested shares every year on top of their salary. Most lenders won't use those shares for servicing, but we know which major banks will accept them. That's an extra $50,000 in income they can use for borrowing capacity. Income type matters as well. Some banks want 24-month trading history for self-employed borrowers. Others will accept 6 months. Some will take your PAYG income on day one, even if you're on probation. Others will make you wait for 6 months. You also might have to get creative with how to get the loan. For example, going back to that client in Melbourne I spoke about earlier, although their borrowing capacity jumped up to $2 million, they did not want to go over 80% and pay over $70,000 in mortgage insurance. So we explored personal loan top-ups to cover shortfall. One lender was willing to do a $200,000 personal loan at 12 or 13%. Expensive? Yes, but no mortgage insurance. The point is, there's almost always a lever that you can pull if you know where to look. Here's the key things to understand. Banks lend against income, not assets. The property is a security, but the decision is made on whether your income plus the property's income can cover the debt under their rules. If you want to scale, you need to understand how they apply these rules to individuals, companies, and trusts. You need to sequence your purchases so you're not choking your own borrowing capacity too early. And you need to be prepared to move between lenders and structures over time. The investors who win in the long run aren't the ones chasing the lowest rates. They're the ones strategically thinking about borrowing power as a resource to be managed and protected. If you want to explore which of these levers might work for your situation, I can help model out your current position, show you what's possible through different structures and lenders, and give you a clear roadmap. I'll leave a link below if you want to book a strategy call. Otherwise, hit subscribe and I'll see you at the next video.